Good morning, everyone. Welcome to this update for global stocks and commodities for the 12th of November. Beg your pardon. This is titled "We still have a very favourable backdrop to global markets, but there's a bit of a but." And as long-term viewers of this video would know, I keep tabs on a wide range of different indicators. And there's just a few things in the bond market that are worth noting. So I'm going to be covering that today as well. So let's jump in and have a look at what happened last week. But first of all, just a summary. So just a couple of warning signs to watch out for. The charts remain highly positive and there's no real change of action required. But there's just a few fundamentals that are a bit of a cause for concern. Now, let me add immediately that you should be trading off what the charts are telling you, not what the fundamentals are telling you, because quite often the fundamentals can be quite misleading within the time frame that most people trade and invest. But it's at least worth acknowledging some changes there. I'll be doing, of course, the stock and commodity trend update as usual. And portfolio analyst last week, I got some really good feedback. Thank you to those that took the trouble to do that. I covered some local lithium, graphite, and gas stocks. Some good, some not so appealing. Also covered US energy and financial sectors in a degree of detail as well, and also looked at the Bitcoin chart, which is really interesting. And there was actually quite a correction occurred last week, which was overdue. So that was Portfolio Analyst last week, and of course there is a free trial available, which would give you access to that. So it's a bit of a nervous week. We saw some sharp profit taking in the Nikkei index on Thursday late. That actually occurred after the Australian market closed. And that was a trigger for selling around the world. It wasn't unexpected, as you'll see when we look at the chart, because the Nikkei had advanced substantially. It had advanced 3,000 points in about 7 weeks. So that bit of profit taking just had to happen. So that in itself is not an issue. It did trigger selling elsewhere, though. It started in Europe, spilled over into America. But I have to say America remained surprisingly resilient considering. But the bigger concerns for me is that, and this has been a fundamental concern for a long time, and that is the bond market. In the junk bond market, the differential in interest rates between junk bonds and the highest quality bonds is unreasonably and irrationally small. People are prepared to invest in junk bonds and accept an absolutely appallingly low yield for the risk involved compared to putting their money in very safe treasuries. And of course, that just reflects the fact that very safe treasuries are paying such a poor yield. So people are being forced to accept a lousy return, but that return is bigger. But the thing about the US junk bond market is that this could lead us towards some serious liquidity issues. And of course, it was liquidity issues that was really at the heart of the GFC more than anything else. So it's just something worth watching there, and we'll have a look at a chart that's a reasonable indicator that some of the major bond players are getting a bit nervous. The other concern too, of course, is the Republicans just can't get their act together and get a tax reform policy out on the table, and so it would appear that any form of tax reform is now going to be delayed into 2018 and or watered down significantly from where it is. So you've got some of the Republicans that are trying to minimise the impact on the deficit is really their issue, whereas the other camp looks at the incredible stimulatory effect of those tax cuts and argues that that in itself, the growth, will take care of the deficit. Let me just take a balanced view of the fact, and I've kept out of this little summary opinions of anybody, mine or anybody else. So this is as much as I can a balanced view of the facts, both positive and negative. The only real potential negative that I can see is in the junk bond market, where junk bond yields make absolutely no sense. It's crazy to be accepting a return of 4.5 to 5% for what are extremely high risk bonds. And the other part about the junk bond market is that there is a very dangerous liquidity mismatch between the bond ETFs and which are basically saying that they're pricing a high liquidity situation at all points in the day when that high liquidity situation does not exist. It's actually a relatively illiquid market. So you've got a very dangerous mismatch in liquidity there. Risk is not properly priced into most financial markets, and that's been the case for a number of years. Or to put that another way, the return that people are accepting is too low for the real risk involved. But look, that's been the case for years, and it hasn't stopped stock markets from advancing. And I think it's just a consequence of all of the quantitative easing and the incredible liquidity that's in the system and low interest rates. So the fact that risk is not properly priced in is not in and itself a reason to to get out of the stock market. The length of the bull market, most of the argument about this rally finishing is about the bull market has been going for 8 years or 9 years or whatever the number is, and it's historically long and so on and so forth. The length of the bull market is a complete red herring. The people that are trying to call a top are citing things like it's been a record number of days since the last 3% pullback or 5% or 10% pullback. All of that you should just ignore. It's completely and absolutely irrelevant. Let's look at the positives now, and there are a lot of them. We've got global synchronized economic growth. I've mentioned that before, so I'm not going to spend time on this. We've got rising corporate earnings, and the US season that's just coming to conclusion, we're about 90% through, has been as good as ever in terms of the growth rates and the number of earnings beats. We've got a low interest rate environment, and whilst interest rates are rising, I think that's going to be done at a very modest pace. We've got no euphoric buying in the market, and that's one of the three fundamental foundations of a major market top. I think we have progressed. We've progressed from hating the bull market to doubting the bull market, and I think now I'm sensing a certain acceptance of the bull market. So I think we are progressing along that psychological scale, but we've not reached the euphoric buying stage. And that is almost required before a major market top. And I'll also add that it takes a while to build up. The market just doesn't suddenly flick a switch and go from acceptance to euphoria overnight. It takes a long time, of the order of 6 to 12 months, and we have no indications that is starting. The strong trends are intact. That's a fact, as we'll see with the charts. No one can argue that the trends are not intact, and we're not seeing any sort of volatility that would indicate that maybe that trend is changing. The market breadth remains near historic highs, but I do note a little bit of weakening in some aspects in the last week or two in the Dow Transports and also in the Russell 2000. Successful investors go with what is occurring now and not what should be. So really work hard on that. We're going with what is happening at the moment and not what someone predicts may happen in the future. Let's just take a quick look at a couple of charts before I move on. So I'll start with, first of all, the Nikkei, because that really was the cause of the trigger for a little bit of selling around the world. So if we pan back and take a big look at the Japanese market, you can see we're still way below the 1989 peak of close to 40,000 points. You can see just how meteorically the Nikkei fell, reached an ultimate low in 2009 after the GFC. You can see there was a massive base there that really started forming around 1992, and we finally broke above that just a few weeks ago. And you can see just how much the Japanese index accelerated. So this turnaround that occurred late on Thursday always had to happen. You can just see how far that index had deviated above the moving averages. So I'm not perturbed by that. I think it's just one of those things, and it may play out with a bit more downside yet over a period of weeks or even months. Now the other chart of interest. This is the junk bond, one of the junk bond ETFs. The code is HYG. Always worth watching. Now this is the GFC. This shows you what can happen in the bond market when liquidity becomes an issue. So this was the peak in 2007 at around 105, and it bottomed out at the end of the GFC at about 62. So lost about 40% of its value. Now it quickly rebounded after the GFC. We got back up to 94. We had another significant dip leading into February of 2016, but then rebounded, and you can see we've just been trading in a fairly quiet and tight range here. This really started around March of this year, so it's been quite a tight market, and we can create a wedge pattern here, and we've now dropped out of the bottom of that wedge pattern. You can see that was quite elevated volume. This is a weekly chart, so you can see quite elevated volume, but we've still got to break lows here and here before you'd really be concerned that that there was something untoward happening in that market. So it's just a little first warning sign, but it's something that I watch basically every day. And it's just a little indicator that maybe all is not quite as well in the junk bond market. Okay, so let's turn to American stocks now. The S&P was lower by 0.2 on the week, but before that happened with the late week sell-off, we did record new highs for the Nasdaq, the Dow Jones, and the S&P. So the trends are still very much intact. The Russell 2000 is lagging a bit, so breadth is cooling a little short term, but look, there's nothing really untoward there, as we'll see from the chart. 2566 on the S&P is an important support level. That's about another 15, 20 points below where we are now. This is a very short-term support, so if it broke, we might go a little bit lower down to the 50-day, but we'll see how that pans out. In terms of exposure and looking at where I believe the most certainty exists, if you own nothing else, I would own some shares in Alibaba. I think it is absolutely up there with where Amazon and Facebook and Apple were 3, 4, 5 years ago. It's hard to find a more robust, likely investment for the next 5 to 10 years. The US dollar weakened against all major currencies on the week. It had a nice rebound, and I think this is just related to the uncertainty around tax reform and what that does to the interest rate differentials. But longer term, I would expect the US dollar to keep moving higher, I believe is the trend. So let's jump in and take a look at some of the charts. Not a lot of change in the S&P, as you can see, and whilst we did get a bit of a dip on Thursday, the market came right back up and closed near its high of the session, and then a very small range on Friday. So really no real follow through to the selling on Thursday at all. So you can't look at that and say that there's anything untoward occurring whatsoever in the S&P. So the trend very, very much intact. Let's look at the Nasdaq. So we'll look at the QQQ, which is the ETF covering the Nasdaq, and you can see it just continues to march on and form new highs. And both sessions on Thursday and Friday, even though Thursday finished lower, both sessions finished on their highs. So there's a unquestionably still strong buying in that market. If we look at the Russell, it's cooling off a little bit, as you can see, a little bit of a downtrend in the short term, but look, there's nothing dramatic or untoward about the Russell at all. Let's look at the German DAX. So we'd had a real acceleration in Germany as well. It really has gone a long way since the breakout. Here was the breakout that occurred in July of 2013 at a big picture level. That was around 8,000 points. We're now up over 13,000 points. So it's been a very strong 3 or 4 years for the German market. You can see some sharp selling on, and this is on a weekly chart, by the way. So some sharp selling occurred at the end of the week, but that is still way above its 50 period moving average, so no concern there in the DAX. If we look at this is the FTSE in the UK, you can see this is on a daily chart. A little bit of selling Thursday and Friday, but look, not as dramatic as here or even over here. So there's really no real signs that we need to be worrying about. Let's just check in on the VIX index. It ticked up a little bit, ticked up from around the 8 mark, got up to around 10, but look, hardly any change in the VIX index at all. And that pretty much reflects what you'd expect. The US dollar, that's not the US dollar. This is the US dollar. Okay, so we've had a nice rebound. We didn't quite get down to this descending or downtrending support line. We may still revisit that. It's possible. But I would say in the longer term, because of the fundamentals, I think the US dollar is heading higher, but we could just get a partial correction of this latest move, or we could get a full correction of this latest move, but I don't think it changes the longer term. The Australian dollar, we've got resistance here around 78. We're down around 76.5 at the moment, and I think that's probably where it's going to stay, or even head a little bit lower. And that would certainly be helped by the Republicans getting their act together on tax reform. Okay, so the Aussie dollar was flat. It was the weakest of the major currencies relative to the US dollar. The yen went up, the euro went up, and the Chinese currency went up as well. The ASX 200 was up another 69 points on the week, so we finally managed to break through 6,000 points. It's been a long time in the making. Finally got above it, but we're now overbought. We've got poor seasonality for banks. We've got a lot of headwinds for the banks, so I don't have a great deal of confidence in what the Australian dollar is going to be able to do, whether it's going to be able to sustain this 6,000 point level. So let's just take a look at those indices. So there's the ASX 200 on a daily chart. So we managed to break above it on Tuesday, but we pulled back on Friday in response to what had happened in Japan. But you can see from the RSI here, we've been overbought for quite some time. We've just managed to scramble above 6,000. I'm fully expecting a retest of that 6,000 level and perhaps a bit of a dip underneath it. While I'm here, let's just look at precious metals. This is gold on a weekly chart. Didn't do much. It advanced a little bit, but you can see there's still just no momentum in the precious metals market at all. We'll look at gold on a daily basis. You can see this sudden sharp sell-off, a little bit of engineered manipulation of the market on Friday, sudden plunge, which I'll talk about in a minute. But it hasn't really gone anywhere much. And this is silver. No real movement in silver either. So let's look at the precious metals market. Gold managed to advance by $6, but there was a reasonable manipulation on Friday where 40,000 contracts in gold were dumped on the market in one hit. That has only one intention whatsoever, and that's to cause a shakeout in the market. That is an attempt to take the market down, because no one in their right mind would do that as part of normal selling. That brought the gold price down by about $10 in the space of a few minutes, but it didn't trigger anything bigger than that. The GLD holdings edged down a fraction more. I track this because it's an indicator of the real buying by longer term investors rather than just speculators, and that's been holding in quite resilient fashion, but it hasn't really been going up either. Precious metal stocks, we've still got no traction there whatsoever, so no change in GDX. Turning now to other commodities, copper eased back a little bit. That's really just moving around with currency. Crude oil was the big resources move of the week. It's broken out clearly, as I indicated last week, and rose to nearly $57. In fact, did spend some time above $57 during the week, trading at a 2-year high. There were falls in crude inventories. There was falls in finished product inventories. So the demand is outstripping supply in the short term, and that's why oil went up. It's quite clear, as we'll see from the chart in a minute, that we've got a new uptrend that's now starting after a reaccumulation period. And once those things start, they tend to run for some period of time. So you've really got to acknowledge that we now have a new uptrend in crude oil, and I think in the short to medium term we're targeting above $60 initially, and then much higher longer term, and possibly up into the $90 area. Now that might take several years, but that's the way that the cycles work in crude oil. Stocks have responded strongly. They're looking quite good. So the sector, as I indicated last week, the sector is now a buy. I think you can start building exposure into it, but just be judicious about how you do it. It's still resources. It's still volatile, and it can still bite you if you are complacent about how you go about doing things. So trade entry and trade management and profit taking is critical. There's spot copper, just easing down a little bit over the last few weeks. Here's crude oil over the last 3 months. Quite a nice move up over the last 3 months. But let's take a wider view over the last 24 months, and you can see that after we came off the lows down here around $30, the price bounced up to $50. And we then had a reaccumulation range. So this range here from the low 40s to the low 50s formed a range. A little bit of a sign of strength here occurred in early 2017, but you can see that we've now clearly broken out. So this was a reaccumulation that started around about March, April of 2016. So that reaccumulation took about 18 months. We've now broken that. And 18 months is a fairly lengthy reaccumulation period, and that generally will give birth to quite a decent run higher over a period of time. So I would expect the bigger picture run higher to last for perhaps several years and reach much higher levels above 60. So that's crude oil. Let's just take a look at the ETF XLE. So you can see we've certainly advanced. We've formed higher highs and higher lows. We've broken out above a key resistance level, and it's gone on with it. So key resistance level there and here, and we've moved up and not quite challenged this one here yet. So definitely signs looking much better in the energy sector. So to wrap it all up, the market might correct 5%. It is quite elevated. It's been overbought for a long time. But my question would be, if the market does correct 3% or 5%, so what? It's going to be much more difficult to try and step out of the way and then get back in again than it is just to accept that there's going to be a short-term pullback in the market at some stage. It's going to happen. Just be prepared for it. Uh, you can minimize the risk or minimize the impact that has by only buying stocks when they pull back. Even though the indices may be continually advancing, individual stocks pull back, and that presents the opportunity. So if you continually do that, then that will help minimize the impact. I think we're very justified to be optimistic that prices will keep moving higher for all the positives that I outlined at the start of this video. I think you should stay invested, but just be very disciplined on entry and profit taking, as I just indicated a minute ago. Portfolio analyst this week, I'm going to be presenting an outstanding local stock. I think it's being ignored by the market, and it's got one of the most perfect textbook charts that you'll ever see. So that, combined with the fundamentals, I think makes it a very, very attractive proposition. And just a reminder, there is a free trial available on Portfolio Analyst for those that would like to partake of that. There's my contact details for anyone that wants to communicate with me, and that's it. A little bit of volatility increase this week, but no big picture changes at all. And we'll see what this week coming has to bring. Cheers.